Good morning. Thank you for joining us today. We've got a really exciting group of panel experts all across Canada. I'm going to introduce them. To my right is Cecilia Williams, the CFO of Allied REIT, one of Canada's biggest office REITs. And then we have Tamara Lawson, who's the CFO of QuadReal, which is the real estate arm of one of Canada's biggest pension funds. And then we have Allison Wolfe, who is the CFO of Oxford Properties Group, another one of Canada's biggest pension funds. And then finally, we have Peter Sweeney, who is the CFO of SmartCentres REIT, one of Canada's biggest retail REITs. Thanks for joining me today.
Thanks, Natalie.
So let's start off with investment strategy in real estate. Given this environment, we've gone from a completely different interest rate environment from just a year ago. We have elections coming up. We have all these global trade and political tensions. Allison, I'm going to throw the first question at you. What is your investing strategy given this backdrop?
So we're really focused on, number one, we have the benefit of being long-term investors, just given our pension capital base. And one of the things that we spend a lot of time on is just our overall capital allocation strategy and actually trying to develop a investment framework and overall allocations that actually allow us to go through fairly fairly challenging times. And so that's when we look at making sure that we're diverse across countries, different regions, and asset classes. So we're not putting too much in one area to make sure that we have a fairly sustainable portfolio.
And where do you see the most opportunities for growth given this environment?
We are still fairly bullish on our industrial and residential sectors. We still see that there's growth there, and compared to some of the other sectors such as office and areas of retail where we still see fairly significant headwinds.
Tamara, what about you?
Similar, I would say, strategy to Allison on the investment side, really looking at asset classes that we think will outperform, focused on industrial, multifamily, data centers, and also mixed use as well. Looking at diversification as a key, both, from a global perspective. One of the things we spent a lot of time on is just our capital funding strategy for a potential downturn. So we're really making sure that we have a lot of liquidity sources, and we're keeping our leverage low, and we're also extending our term, but maybe being a little bit more floating rate, having more floating rate exposure, to be prepared so that we have access to capital. We're similar as Allison in terms of we have long-term money, so we can kind of look at things from a long-term perspective. We are also doing a lot of development because we think there's more value there, and rather than buying things at extremely low cap rates, we see an opportunity to build out in certain asset classes.
Cecilia and Peter, you guys mainly invest in Canadian real estate. You're public companies. Where do you see the opportunities for growth in the Canadian market? Cecilia, let's start with you.
Okay. Well, we've committed to investing $900 million in development over the next 5 years, primarily in Toronto and some in Vancouver. And then this year, we've already done more than $500 million in acquisitions. And there, what we believe is the best approach is to have a very conservative balance sheet in terms of debt metrics so that we can take advantage of acquisition opportunities as they come up. And so while we don't necessarily have acquisition targets that we set every year, we have been averaging roughly $300 million for the last few years per year, and I don't see that slowing down over the next couple of years. So it would be a mix of investing both in our development activity, which we've committed to, as well as acquisition opportunities as they arise.
Peter?
Yeah, I think the story for SmartCentres is not dissimilar to maybe some of the themes we've heard already. The reality in Canada, at least, is that over the last almost 8 years, cap rates have continued to compress, notwithstanding maybe expectations given interest rates, particularly last year, moving forward. Cap rates didn't move up in sync with interest rates last year. They at least stabilized, and then so far for the first 9 months or so of this year, cap rates have compressed further. So at least for SmartCentres, the challenge is to be able to buy existing income-producing assets that are accretive. And so, we're continuing to focus on development. We've got a large development team. We recently announced, at least updated our announcement that over the next 5 years, we plan to embark upon over $12 billion of new initiatives, new developments that we expect to start over the next 5 years, of which the REIT share will be over $5 billion of that number. So for at least SmartCentres, the near future at least, will be focused on development, and the yields on development in virtually every type of real estate discipline in Canada far exceed the yields that are being found in most cases through acquisition. So that's not, I guess, dissimilar to the experience of my counterparts up here.
Allison, you at Oxford, you guys are more of a global investor. You invest in a lot of the global gateway cities in the world. Given all of the volatility that we're seeing in Hong Kong and the UK and the US, I mean, are you worried about sort of capital flow restrictions happening around the world? Are you worried about kind of a dry up in capital flowing into real estate?
Yeah, no, it's interesting. This came up in discussions, and one of the stats that the team shared was when you look at capital flows just into the U.S. from China, it kind of peaked in 2015 and 2016, and I think, and I'm sure someone has a Bloomberg who can fact check this, but I think it was almost like $70 billion, whereas you look at this year, we're close to or less than 10% of that volume. And I think this is more in line with normalized kind of historical volumes, but when you remove that amount of capital flow into a market, I think you've seen some softness on, there's not a lot of buyers for, multi-billion-dollar office towers. And so interesting enough, you think of, and we've been surprised with the strength of the market in the UK. So in London, the best properties in London, you really haven't seen us, particularly, for example, on the office side, you haven't seen what you would have expected to see. Cap rates moving, you've actually seen further cap rate compression. And part of that is when you take a broader global context and you start to say, what are your alternatives? And so it's a very interesting time when, if you're focused on just things might be soft in New York or London, but then you take a broader global perspective and you're still seeing capital wanting to go into these global gateway cities. And some of it is not so much return driven, but it's actually just capital preservation, which makes it hard for investors that are more focused on actually having to generate a return versus just trying to move capital to preserve it. So interesting times. And so one of the things that we've had to look at is evolving how we're executing our strategy. So instead of just single asset purchases, we've actually, last year, we did 2 large portfolio transactions. We took a public company private in Australia, and then we did a large US industrial transaction. And so looking at different ways to execute against the strategy is something that we've had to look to, just given the compression, the pricing compression and the returns on just single asset, really high quality core assets in these global gateway cities.
Right. I feel like we're starting to see a lot more capital investors looking at markets, specifically safe havens in the event of a global recession, like Canada. Tamara, what have you noticed in terms of the deals that you're around, in terms of the investors that you talk to? Are you seeing more of them start to look at Canada as a place to invest? Because we saw some of that drop off after the Chinese capital restrictions came into play in 2016. Is that coming back? Are you seeing other types of investors come back to the market?
Yeah, I mean, yes, for sure. So in Canada, we're very focused on both Vancouver and Toronto markets. And you're right, in Vancouver, we did see an impact in that market. Not so much by the government legislation, but more just by less capital flowing from China. But we have seen other investors come into that market. There's still a lot of capital globally. Canada is viewed as a safe haven, as you indicated. People feel very comfortable with the fundamentals in both the Vancouver and the Toronto market. So we really are seeing capital continue to flow both domestically and internationally. I think we think that will continue.
And I'm sure that's affected the competitive landscape between public and private companies, especially as we're seeing a lot more private money flow into alternatives like real estate. How does that affect your business decisions as a public company, Cecilia, in terms of the deals that you bid on, et cetera?
Well, I think in Vancouver continues to be incredibly prohibitive from an acquisition perspective, just the cap rates. It's impossible to find anything with a 4 handle. So you're looking definitely at 3.25 cap rate. And I think part of it is what Allison referred to as a lot of the investment into Vancouver is for capital preservation. People aren't necessarily looking for a return, they're just looking to preserve their capital. And so while Vancouver has been transitioning from a secondary market to a primary market, you can get your head around the cap rates a little more now. The cap rates in Toronto are still higher than in Vancouver, and it's certainly a stronger office market. But we're wanting to definitely grow in Vancouver, but it's been difficult to acquire there. So we have found ways to partner with local developers by financing their developments and then buying in at 50%. And so there we're seeing the ability to grow in that market, but it's very prohibitive from a pricing perspective.
Peter, what are your thoughts?
Yeah, I think, we're fortunate, all of us are, frankly, in this current environment from a capital raise perspective, because there's an abundance of both equity and debt, whether you're a private real estate company as Oxford and QuadReal are, or whether you're Allied or SmartCentres or any of the Canadian REITs, where there is an abundance of debt and equity. And that won't always be the case. And so I think part of our role is to manage for the future, manage for those times in the future when capital of any type may not be as readily available, and to plan for those troubled water times. And so, again, notwithstanding the ebullience of today's environment, there will come a time, and it's tough to predict, so we choose not to, but there will invariably come a time where all of us will have to make very different decisions on capital allocation and on raising capital and perhaps on disposing of assets that we may not like. So it's in these times where we're trying to sort of put the places or pieces of the plan, if you will, in motion to accommodate viability in those more troubled times. So when you think about balance sheets, all of us have, at least on a relative basis, some of the most conservative balance sheets that anyone in the developed world has ever seen, at least from a real estate perspective, when you compare them to what similar companies would have looked like either 10 years ago during the most recent recession, or even in the early 90s when the world imploded from a real estate perspective. And so all of us are sort of trying to look at ways and means of engineering ourselves so that when we do hit those troubled waters at some point, that we're well positioned actually to take advantage of maybe growing further in those more troubled times, and to have balance sheets that can accommodate maybe some growth at perhaps highly discounted prices when there are others that might be in trouble. So those are our thoughts, and I don't think I'm alone in that. With respect to the Canadian market and the specific Toronto, Vancouver, and other markets, as I mentioned, we're continuing to see an enormous amount of demand, both domestically and from international sources, for product, and it's very limited if you're looking for quality. And so that's compressing cap rates across the board, which again makes it difficult for all of us to buy existing product in the country.
One of the things that we're seeing a little bit in Canada that we haven't seen as much historically is just family office investment in real estate. I mean, it's been the case, throughout Europe and in the U.S., but it's becoming more of a factor in Canada. That's driving some, more flows into our sector. The other thing I just wanted to mention about, just on the residential sector, the Toronto market continues to be very strong on the housing front. Vancouver's, off a little bit, especially on the very high end, on the luxury side of things. But we're seeing, we're developing condos in both of those two markets. We're still, seeing very good demand. One of the things we're very focused on is transit-oriented housing, multifamily condos and multifamily development. So, that's why, we think that that sector will continue to do well.
Perfect. Let's switch a little bit into one of my favorite topics and the popular topic of the day, co-working and WeWork. I'll start with you, Allison, because Oxford, you guys have WeWork as a tenant in a few of your buildings. You have your own co-working, Oxworks in Calgary. What are your thoughts on what's happening with the company, and what potential impact do you see happening from the potential fallout of what could happen with WeWork in the days to come and the months to come?
Well, I think maybe I would just say the concept of co-working has existed for a long time, and I think one of the things, and I don't have any specific comments on the company, but I do think the reality is, as major landlords, if you're a small to mid-sized business, renting space is a huge challenge. And it's and so when you start to look at how our current economy's evolved, and businesses are growing and they need flexibility, so the idea of signing, and especially a 5 or 10 year lease and the upfront capital is just very punitive. And so I think the idea of providing co-working, like that's obviously it's been here for a while, it's going to be here to stay, and I think that's one of the challenges of major landlords, is actually recognizing the need to serve not just kind of a large institutional tenant base, but also how do you actually serve that other base in a very efficient manner. And so I think that the success of the organization just highlighted a need and a customer base that probably wasn't being served as well as it could have been.
Right. I mean, I think in the longer term, a lot of people agree that co-working is here to stay. It's going to evolve in different ways. But just in the short term, like specifically, WeWork's presence in London and New York, they're the biggest private office tenants here, right?
Yeah.
How do you think, I mean, are landlords like yourselves worried about what could potentially happen with vacancy rates, with deals on the line in the short term, and how it might impact the office markets that are already a little faulty to begin with? Cecilia?
We only operate in Canada, so I can speak to, in Toronto, WeWork is maybe less than 1% of the GLA. It's about an 80 million square foot market. WeWork is not in our portfolio, but we do have co-working companies in our portfolio as occupiers. And the largest one would be Spaces or Regis. They've been in our portfolio for almost 10 years. They occupy one of our prime assets on King West, 500 King West. They're also in 180 John. And that being said, they occupy less than 1% of our total national portfolio. So while I echo Allison's comment that co-working is not a new industry, co-working has been around for a very long time, I don't see them ever getting a large chunk of the market in Canada, certainly not. I think I've heard people quote 30% of the market. That won't be the case in Canada. I can't speak to London and New York, but they do have, co-working does have a place in a healthy ecosystem. They incubate tenants. Again, I agree with Allison, there is a need for that flexible, shorter term space, which is why Spaces and Regis has done so well, which is why WeWork did so well, certainly to start. I think one of the reasons WeWork didn't do well in Canada, certainly didn't do well in Toronto in terms of securing great space, is that when they entered the market maybe 5 years ago, I don't think they understood the market very well. They were looking for 3 times the market level of TIs, and they weren't willing to offer a guarantee or provide a covenant, and it just really didn't make sense for owners of assets in the city to engage in a transaction with those terms, given the strength of the market. It may make more sense in perhaps a compromised market like Calgary, but I'm not sure that they've secured any space there that I'm aware of. So that's the landscape in Canada from my perspective.
A couple things that I would just add to that is I think you have to kind of separate the issues at WeWork from the co-working business model, from some of the participants in that industry that are well capitalized, do have a good business model. So, I mean, we don't have any business with WeWork, but we do have other co-working companies that we are in business with. It's not a big part of our portfolio at all. I think worldwide it's only 2% currently. I think people are projecting that it will become a multiple of that number over time. I think what will be there could be a short-term impact in certain markets and certain assets with certain landlords that do have a big exposure. I do think it will be a good opportunity for some of the other participants that are sort of well managed and well capitalized to kind of move in and take over some of that space. I think WeWork was in a situation where they had to grow a lot because they had this crazy multiple the competitors, their competitors have been, have much lower multiples, and they haven't been kind of growing at all costs. So I think, I think there could be a little bit of disruption, but I do think the business model is here to stay. And, I think, maybe in certain markets it will have an impact on absorption, but I think it'll be an opportunity for some of the other players to come in and sort of take over some of that business.
Perfect. Let's move on a little bit to the environment for borrowing and raising debt in Canada. We're seeing a lot more REITs do bond sales, a lot more real estate companies go towards doing unsecured debt. So, Peter, what are your thoughts on the borrowing environment in Canada?
Well, as I mentioned, I mean, it's a great time to be a borrower, so to speak, at least in Canada. The bond markets are quite active. I think it's fair to say that if you're in the market for debt today, you should be thinking seriously about stretching the term as long as you can, given where rates are. Again, keeping in mind the conservatism of trying to manage large real estate companies and the long-term nature of our assets. That wouldn't have been perhaps my answer to this question maybe a year ago when rates were rising. So let's take advantage of low rates while we have them, so to speak. When we think, at least at SmartCentres, when we're thinking about our balance sheet, if we had dialed the clock back 2 years ago, we would have had a balance sheet that represented or had 2/3 of our debt represented by conventional mortgage debt, and the remaining third was bonds. And over the last 2 years, we've engineered that to almost be inverted, so that when we sit around this time next year, we would expect to be able to say 2/3 of our overall debt would be unsecured and 1/3 would be secured at that time. That isn't an accident. It didn't happen by chance. It was an intentional strategic initiative that we embarked upon 2 years ago to ensure that longer term our unencumbered asset pool grew. And so as we sit today, the unencumbered asset pool sits at about $4.5 billion. Over the next 12 months, it'll grow to exceed $5 billion on a $10 billion balance sheet. So for us, that's quite a dramatic swing in a relatively short period of time. So we're going to continue, as long as the markets are open and receptive, to continue to use the unsecured markets as a strong provider of capital and debt capital for us.
Yeah. I mean, I would just say I think we're exceptionally fortunate in Canada because we have a very strong unsecured market as well as extremely strong banking system. And so, having just a chance to look at from a more global perspective and the strength of the banking institutions and the underwriting standards actually provide stability to the market, even when we start to see, I'm going to say, more blips where you'll see, just from my perspective, you'll see, last December, we had some challenges in the market, and I see greater reactions outside of Canada, some of those blips, and I think part of that has to do with just, the strength of the institutions and the underwriting standards, where they're able to kind of see through some of the noise, whereas it feels a little bit more knee-jerk to some of the reactions on some of the other global basis. So,
the Canadian bond market is a relatively new phenomenon for Canadian real estate owners. So the bond market's really grown up over the last 10 or 12 years, and prior to that, it would have been very unusual for a real estate company in Canada to be raising unsecured bonds conventionally the way that we're doing these days. So we're still learning. The regulatory environment still is very stringent relative to perhaps some other jurisdictions. And that certainly helps, and I think it gives investors like yourselves perhaps a strong level of confidence in the issuers of debt in Canada.
Yeah. Tamara, what are your thoughts? I mean, we're seeing a lot of Canadian borrowers going to the U.S. What are they getting there that they aren't getting in Canada?
Yes, good question. As everyone's mentioned, we do have a very strong capital markets in Canada, but there's a certain amount of depth that we don't have in Canada that there is in the U.S. So I think, from our perspective, we're looking at a significant amount of growth over the next 5 years. I think we're estimating to do about $3 billion in debt financing per year. So I mean, that's just not. We can't do it all in the Canadian market. So we're looking at the U.S. private placement market, the unsecured market here, as well as some of the other global markets. The Euro market, obviously, interest rates are very low in Europe, and so and there's a very deep bond market over there as well. We're looking, because a lot of our growth is international, we're also looking at trying to hedge our FX risk, so we're trying to borrow as much as possible in currencies like the US and the Euro and the pound. So yeah, I think even though we do have a very sound market in Canada, we can't meet all of our needs in the Canadian market.
Cecilia, you guys have done a few bond sales this year at Allied.
We have.
What's the environment looking like moving forward? Is it still attractive?
Well, most recently, we took advantage of the fact that the underlying reference rates have been declining, and at the same time, the spreads have been declining, and they don't normally go in the same direction, as it's been explained to me. And so we were able to take advantage of that a couple weeks ago, and we did a 7.5-year bond, $300 million. We did a 10-year bond back in August, also for $300 million, and it was primarily, both of those bonds were primarily to early repay debt and refinance and extend our weighted average term to maturity. I don't know how long the current environment will continue in terms of those two rates going down in the same direction. I just understand that it's very unusual that is the case, and so we were happy to take advantage of it. I don't know how much longer it'll last, but yeah, it's been a great year to raise capital. We've raised $1.1 billion this year, roughly half debt, half equity, and we've been able to deploy it. So we're very fortunate in that regard.
Perfect. So for my last question, because we have 2 minutes left, what is the probability of a Canadian recession in the next 12 months? What are your thoughts? Let's start with you, Peter.
So let's just make sure we understand the question. What is our personal opinions on the probability of a Canadian recession within the next 12 months? I think the reality for Canadians is that we follow so closely the U.S. economy, and so if the U.S. economy stumbles, then typically Canadians feel it, perhaps on a more muted basis, but they still feel it, or we still feel it. And so I think the reality, or at least the expectation for now, is over the next 12 months, as we gear up for the election in the United States in November of next year, that there is at least an expectation that the U.S. will not fall into any sort of severe economic recession. Again, keeping in mind what those who are running for office in this part of the world are trying to do. And so if Canadian industry follows generally that trend, I think it's fair to say that in Canada, at least for the next 12 months, we shouldn't expect a recession to be taking place.
Allison?
Didn't Peter use up all the time?
No.
I should have said yes
Still
or
got
no.
1 minute left.
No, I mean, all great comments. It's impossible to say, U.S., what's going on with U.S., China, what's going on with the federal election, what's going on with the U.S. I mean, there's so many. I wish I could answer that question. As people smarter than me would probably have a view, but I think within the next 12 months, that's a pretty short time frame. So I think we're probably safe within the next 12 months, but not sure how much further beyond that time frame. Subject to a couple tweets. Yeah.
Tamara?
So, I mean, I guess I would agree with the comments made. One thing I would say, though, obviously the inverted yield curve that we're seeing would imply that, it's likely. But I think we're in, a bit of a different situation here with a sustained, cycle. So, and, given the other comments, I would agree that I don't expect to see a recession in the near term.
Celia?
I would say very low, but you asked for a percentage probability,
Yes.
so I'll say 20%.
20%. If you guys had to give quick percentages, we're out of time. But Tamara?
I'd say 35.
I'll go 25.
Yeah, I'll say 20 or less. It's relatively low.
Perfect. Well, thank you so much for joining me. Thank you so much for listening to our panel.